Morning, everyone. This is Lian Seng. So today we would be having a very heavy content. So, yep. So we'll just go through the company results briefly, and then we'll pass the presentation to Richard, who will elaborate more on the sector report, which is on Singapore REITs, in particular industrial REITs sector. So without further ado, let's move on to the first presentation on Singapore ONG. Okay, for Singapore ONG, we have actually downgraded the rating to accumulate. This is due to the recent price run-up. Nonetheless, we have actually upgraded the target price from the previous $1 to $1.37. So let me bring you through on what happened in the last quarter and why did we increase the target price and the forecasted EPS. So as you can see, the top line is actually contributed by all the three segments. So their core segment, obstetrics and gynecology, ONG, actually had a higher total deliveries of 7% year-on-year growth. So this is actually a very positive sign if you compare to a negative 0.6 growth in the total Singapore. If you compare to the total deliveries in Singapore. So a 7% year-on-year growth in their total deliveries, and that if you look into their market share, it actually increased 3.9% of total Singapore live birth, as it increased 0.1 percentage point to 4%. Sorry. Yeah, so we are actually expecting that this growth momentum to continue, given in the second half, being three factors. One, the second half usually have a higher birth rate. Secondly, we are expecting that Dr. Chu Wan Ling, who has actually moved her clinic from Gleneagles Hospital to a more favorable venue in Mount E, that we should be seeing some traction from this new venue. Mount Elizabeth Novena Hospital is actually second in the Singapore hospitals, following Thomson Hospital in terms of ONG services. So we should be seeing some contribution from the new venue. Thirdly, we also should be seeing that the new obstetrician, Dr. Hong, who just joined in July, to contribute in the second half. So let's look into the second segment, cancer-related segment. So for cancer-related segment, as you can see here, it's actually grew more than double because of higher loads that Dr. Sin Pang is receiving. However, it's still dragging on the bottom line because Dr. Radhika is still on the break-even point, and they just have recently have a new specialist who joined them in May. So she's still in her latency period. So nonetheless, as you can see, that it actually more than doubled. So yeah, you know that Dr. Cindy Pang is actually doing very, very well. And more importantly, dermatology segment, which just started to integrate. Which just started to contribute to the group since January this year. I'm sorry. So you can see that it actually contributed 4.3 million to the top line, and 1.5 million to the bottom line. So this 1.5 million net profit after tax, right, is actually meeting more than half of its full year profit target when it first got acquired. So during the acquisition deal, right, they actually made a promise of contributing at least 2.3 million for 2016. So they have actually achieved 65% of their full year profit target. And considering that more than 50% of their revenue comes from product sales. So they're selling all those skincare products, and that actually doesn't requires any requires any doctors or specialist consultation. So the group is actually trying to promote more of the product sales by marketing in all their SOG clinics. They are actually started this marketing campaign. We have seen posters in clinics, their SOG clinics, selling their laser treatment, and they are also trying to work on how to market their cream-based products, and they are starting to train up their staff, their nurses on selling these products. So we should be seeing that their product sales as well as their dermatology services to contribute more in the second half. So as you can see that actually their net margin increased 2.1 percentage point. This is mainly due to firstly, they increased slightly of their obstetric services pricing. Secondly, they have actually deployed some of their management staff over to their dermatology business for integration purpose. So that actually reduced percentage of staff costs over total revenue. Yep. So they have also declared an interim dividend of 1.53 cents per share. That's actually a 74% growth as compared to last year's of the same period. So to reiterate, we have an accumulate call and a target price of $1.37 on SOG. Next, on Q&M. So for Q&M, we have maintained our neutral call and our target price at 72 cents. So let's look into their respective segments and the reason why we are actually more optimistic. We are cautiously optimistic on the second half. Okay, their core business on dental and medical clinics, it actually has a higher revenue because of their existing and new clinics. The new clinics actually includes acquisitions as well. As you know that they have actually acquired 7 new dental clinics in Singapore and 4 new clinics in China. So all these together, it actually contributed to 30% growth year on year. As for their supplies distribution business, the acquisition in China actually helps to contribute to an 81% growth. So these two segments helps to offset the decline in the revenue from manufacturing segment. So why is there a decline? As you recall that their editor factory in China relocated to a bigger space in December last year. So they were facing some of operational logistic issues because of the new factory location. And management guided that they expect it to turn around, and they are seeing better sales in June 2016 as compared to last year. And we are also optimistic that manufacturing should be turning around in the second half because of this new factory location. They are able to double up their lines to 5 lines. Given this new capacity, they should be able to meet a higher demand, and they should be able to achieve economies of scale. So with that, we should be seeing a higher revenue as well as a higher contribution to the bottom line. And just to update on their recent news on the spin-off listing of Idita on China New Third Board. So management announced that they would be having this EGM in 26 August. And if shareholders voted in favor of this spin-off listing, the group should be having an effective interest in Idita of about 38% post-spin-off. And they guided that should everything went smoothly, the earliest date that we might be able to see Idita got listed on the new third board would be by end of this year. So let's stay tuned to end of this year to see how everything dries on from there. And their current they are actually currently in a net debt position of about 24 million debt. They are sitting on 25.5 million cash, and this is actually ready for deployment. This net debt position is arising from, as you know, there are 3 years. They actually raised 60 million from the 3-year multi-currency term note, and that would actually expire in 2018. So they intend to use this fund to expand their clinics business in Singapore as well as in China. But some of the deals actually got lapsed. So there are this large pile of cash sitting by, and this 65 million actually is sufficient, in our view, that is sufficient to fund about at least 20 outlets if we based on historical deals. So if they are going to step up on their acquisition, that should be able to lead to a re-rating. Lastly, they have actually declared an interim dividend of 42 cents, 0.42 cents per share. This is actually same as second quarter last year. So just to reiterate, they maintain a neutral call, and we have maintained a neutral call and our target price at 72 cents. Next, I will pass on to Peter, who will elaborate on GLP.
Hi, morning everyone, Peter here. Trust that you have a good weekend. So GLP reported its results last Friday. It's better than expected, mainly driven by better performance over in China. So what happens is, okay, revenue was up 9%, $207 million US. So there was higher completion and stabilization of development projects in China, and these projects not only were they ramping up to be quicker, but also had like increasing rents. And second factor was that there was also an increase in management fees from this fund that they were paring down stake, this US income fund partners too. And subsequently, at the bottom line level, it actually did drop around 24% or so, and this was mainly due to the lower revaluations on the investment properties because of the change in cap rates and discount rates. Now, we just talked about the operating performance in China. So China portfolio stayed resilient in the first quarter of 2017. China rental income was up 3.3% year on year, up to $774.2 million, and customer retention was up 5 percentage points quarter to quarter to 71%. Effective rent growth was up 6.2%, and this compared fairly well to 2.9% in the fourth quarter of 2016. But however, like I've mentioned in the previous report, as well as now I'm going to reiterate that this performance is not expected to last simply because of the near-term oversupply in certain parts of China. And this mainly refers to the third-tier and second-tier cities. So, but nonetheless, in the first-tier cities, performance is still going relatively strong, and this is an encouraging factor that that we have to pay attention to. Now, in the first quarter of 2017, there was stronger development profits, and this was driven by one logistic facility in the completion of one logistic facility in Japan, and that is the GLP Atsugi 2 property in Greater Tokyo. This property, when it's completed, it booked in a development profit of $65 million, and this amount has quickened up the pace of development profit target for GLP in 2017. So in 2017, they target US dollars $200 million, but they've already clocked in 65 million, and this represented 32.2%. So mind everyone that right now is the first quarter. So if you extrapolate this, they're already ahead of schedule. And they already started developing 20% of their targeted development starts, pretty much on track. And this 20% is equivalent to around $282 million. And these developments are mainly in China, where they target properties to develop properties with at least an average lease ratio of 87%, or places where there is limited supply. So finally, its gearing came in at 16.6%, but we expect it to drop even further to 14.4% because of the, like I mentioned just now about this, the paring down stake in the GLP US Income Partners 2 fund. And if you matched it on the internal target of 40%, 14.4% is less than half of where it is right now. So we expect the group to pursue acquisitions, and where they be looking at, it's mainly on what the management has actually shared. So I can't, while we can't, it's still too early nothing is concrete at the moment, but we are thinking that they're most likely looking at the US markets simply because of the strong growth in performance in the group's US portfolio. Because of the effective rent growth from renewal leases, it was up 20.7%. So this is quite outstanding, and the reason for the positive operating performance is because of the region's positive demand and supply dynamics, and this mainly comes from the undersupply of modern logistic facilities over in the US. And nonetheless, the people who are really looking up to increase in space are the e-commerce businesses. All in all, this region will be perhaps the next growth prospects that GLP is looking at. And finally, we maintain our accumulate with the same target price of $2.28. The last close was $1.93. Now I'll move on to Hock Lian Seng. The results came in a week ago or so, but due to some delays, we are not able to push it up. So, but nonetheless, here it is. We saw pretty impressive top line growth, 47.5%, and this was mainly from the higher contribution from the civil engineering segment. While there was higher revenue growth, but on the gross profit level, or specifically in the gross margin level, we saw a continuous decline on gross margins, and this is because of the, like mentioned before, of the amount of competition in the market right now, as well as as well as it's just a lot more competitive compared to how projects were being done in the past. Now, on the profit before tax level, it was mainly driven by higher contribution from a joint venture line, and this mainly pertains to the revenue recognition of the Skywoods residential development property. So having said that, now let's look at the first point. Revenue recognition of the Skywoods is near the completion. So as at the first half of 2016, most of the revenue has already been recognized. So why do we? So this is mainly contributed because this is mainly, or put this way, I mean we see from this point of view because the project is 99.5% sold, and it has already reached its TOP in May 2016. So having said that, there is not much development profits to be recognized from this project anymore. And the next thing to share, to identify to everyone is that the development profit from this project, it contributed to 78% of profit before taxes in the first half of 2016. So going forward, without development profits or without property development profits, we're going to see the group levels revenue and of course the profits will not be able to keep up. And the next thing is that for the next tranche of property development profits, it will not come until 2018 or possibly new projects if the group happen to take up any. So still on the property development segment, the group has recently launched this new industrial property at Tuas Avenue. So the name of property is Shine at Tuas South, but sales have been lackluster. So this is a 174 unit development, but upon launching in the second quarter, the group has only managed to sell like around 3 units or so, and we are not expecting much upside from here simply because of the weak industrial property landscape. I'll not dive into too much details, which I will let Richard, who will be talking about the industrial segment. And finally, back to the core business on civil engineering segment. So just now we talked about the further compression of gross margin in civil engineering. We expect this to continue to drop, but nonetheless, you can see that if you look at my report, the decline has really come to it has pretty much slowed down. But nonetheless, at 5.1%, which is how much gross margins from civil engineering has came in the second quarter, this compares very palely to like in the past when it was like double digits or so. And even if now, I mean, this 5.1% mainly pertains to the existing project that Hock Lian Seng has on hand. So even if they clinch new projects, it's unlikely to boost existing margins because of the again, I said, the intensity of competition out there. Finally, we maintain our reduced rating, same target price, 31 cents, and the last trader was 33.5 cents. With that, I'll pass the time to Guang. So we're talking about China Everbright Water.
Hello, morning. It's Guang here to talk about the first half results on China Everbright Water. Now let's look at the financials. The top line. Okay. Before we talk about the financials, we maintain our accumulated ratings, but we revised down our target price from 73 cents to 69 cents, which implying the around 17% upside potential. The financials are shown here. The top line, the revenue went up by 40% to 1.3 billion Hong Kong dollars. The increase was due to the revenue from construction segment, because in the first half of this year, the construction services took up around 53% of the whole revenue compared to last year's 36% during the same period. However, the gross profit only went up by around 5%. This was due to the lower construction gross profit. According to the management, the first half of this year, the gross profit margin from construction services was around 21% compared to last year's 30% in the first half of the year. So accordingly, the operating profit only went up by 3%. This was due to the higher overhead costs and also the FX losses pressurized down the operating profit because there are three loans which was the financing needs were pegged to the US dollars. Total amount was 1.4 billion US dollars. But in March, they already paid back two loans, and the final loans they already paid back in the end of the July. So the second half of this year, the management expected that the FX impact will be reduced. The bottom line, the net profit went down quite a bit by 15%. This was due to the increase in borrowing resulting in higher finance costs. Currently, as of June this year, there were 5.6 billion Hong Kong dollars borrowings, and the amount that denominated in RMB was 56%. So in the second half of this year, the management will try to refinance to make more debt in RMB rather than in foreign currencies. Also, because of the one-off change in calculation of the deferred tax, the net profit went down as well. So overall, the design total capacity of the wastewater treatment reached 5.1 million cubic meters, and the management didn't change the full year target of 1.5 million cubic meters per day. So in the second half of the year, they expect that there will be more upgrading works and the water tariff hike, especially for Dongda's projects. Recently, the market raised the concerns on the collectability of receivables because the sluggish of Chinese economy, the northeastern part of China, the government is facing the fiscal difficulty. That's why they didn't manage to pay the overdue amount in the near term. However, the management already dealt with the local government to work on the yearly repayment scheme. So they aim to reduce the total amount of 9.7 billion Hong Kong dollars of account receivable by this year end. So moving forward, the management will keep expanding the business scale because they expect that the economy of scales will reduce their operating cost. Next, I will pass to Jeremy Chung to talk about DBS.
Hello, good morning. Okay, so here's the results for the DBS. So they have come up with respectable net interest income performance despite a weak environment, and that's because it is the loan books have grown, and also there's cost savings on the customer deposit side. So it's not so much about charging higher interest on their loans, but it's more on the cost saving side and the growth of the loan books, primarily driven by building construction loans and housing loans. So the second part is the lumpy non-interest income. Its contribution is from the investment banking and net income from investment securities. The portion of the investment banking would come from the underwriting of the Fraser Logistics, Manulife, US REIT, and the high flux perpetual capital securities. So moving forward, the net interest income would be will perform less. The growth will be a little bit more muted, as it couldn't punch above its weight because of the low interest rate environment. So probably we will look a little bit more towards the non-interest income to cover for that lack of growth. However, we would prefer to see the growth coming up from a stickier wealth management segment rather than the lumpier investment banking side of the business. And the next thing about the non-interest income is also the performance will be brought down by actually the Chinese trade loans, which continued to decline. It went down 20% quarter on quarter. So without any okay, before that, I would like to say that it went down because the onshore borrowing rates continue to be lower than the offshore. So as long as this continues, we would not, we couldn't really depend on the Chinese trade loans to actually boost up the performance. So as for the SWIBOR exposure, one thing is that we like to say is the additional 270 odd million that was given out to SWIBOR in June and July was actually because to bridge two projects, right? Because one project is 50% completed, the other one is 80% completed. So DBS deemed that it is in the interest of all stakeholders in this situation that they help to provide these loans to bridge it. And most importantly is the decision, they came to this decision because DBS knew the counterparties, they knew the end user of SWIBOR for this project, and they know the private equity firm of this project. So to assess the matter, we have to look at it from the business point of view rather than just simply the financial ratios, etc. And in the report, I also mentioned that in total, the exposure to the offshore oil and gas could be managed over time because most of these customers are capital equipment owners. So this capital equipment will be leased out, right, at the lower rate. It will be adjusted according to the oil price. But it doesn't mean that it will go down to zero. There will still be cash flow coming in. So in the meantime, while it's adjusted, while this thing is happening, the companies will have to raise equity or assets, do asset sales or go through mergers. Such restructuring would mean that the banks may have to set aside over time provisions, but it will not be something which is that the banks cannot handle. Okay, so finally, we maintained a accumulate call at the price of 16.10, and that's not because the business is on a growing phase, but rather that we feel that the price is oversold owing to its owing to the market's attention to DBS's exposure to the oil and gas, and we like to emphasize that the price is derived from a 5% discount to forward FY16 book value. Okay, with that, I'd like to pass over to Richard for the SMRT.
Hi, good morning. This is Richard speaking. Okay, so we published results report last week on SMRT, and this morning we published for ComfortDelGro. So I'll go through both the transport operators now. So for SMRT, the title of the report is more of the same Dow news. I won't spend too much time on this because we're still advocating that shareholders should accept the scheme. Our target price is 168, which is what Temasek is offering. Last close on Friday was 1.625. So if you just make a quick glance through their biggest revenue generators, which are train, MRT trains, buses, and taxi, they are all down. The public transport, the fare businesses, which is the trains and bus, largely down. Revenue is down because of a lower average fare. You recall that in December there was a reduction in fares, and then there's cannibalization for their MRT and bus services by Downtown Line 2. The other thing is taxi also is down 7%. They have a smaller hired out fleet. So the two key things to take note is rail segment losses worsened in this quarter. It worsened both quarter on quarter and year on year. They reported 9.4 million loss this year. So if you compare just one quarter ago in 4Q16, it was 8.5 million. And oh, sorry, there's a typo here. So this should be, oh no, this is correct, sorry. So one quarter ago it was 4Q16, that was 8.5 million loss, and exactly a year ago in 1Q16 there was a 5.3 million loss. So you can see that the losses has been growing, and it's grew to 9.4 million this year in this quarter, 1Q17. And even their largest profit generator of rental segment saw weakness too. So it recorded lower year-on-year profits for the first time ever. Revenue and EBIT were 1.3% and 2.4% lower year-on-year to 32 million and 21 million. So in conclusion, we're still advising investors to accept the scheme, because we see that SMRT for quite the intermediate term will continue to have a state of depressed earnings. This has got to do with the higher expenses, operating expenses, in order to comply with new standards and for maintenance on the aging system. Moving on to ComfortDelGro. To summarize, the bus model has been concluded. The next thing is to look for the transition for the Northeast line. So we have maintained, rather we have downgraded from buy to accumulate. We actually upgraded it in June after Brexit during the sell down, and it had appreciated about 7% since then, so we have downgraded back to accumulate. Our target price still remains unchanged at $3.21. The last close on Friday was 286, but I think today it's gone up quite a bit already. So we'll just focus on their three biggest business components, which is bus, rail, and taxi. So you can see for bus, revenue was down. Rail revenue was up. This is mainly because of the opening of Downtown Line 2 in December last year. So they had significant increase in ridership for that increase the extended line. Taxi revenue was 2.8% higher year on year. If you look through the comments here, they've actually been affected by weaker foreign currencies of pound, Australian dollar, and renminbi. So these actually affected their group level revenue. The group level revenue here is down 1.4% year on year. The actual increase was 3.1, but it was eroded by unfavorable currency translation of 18 million. Having said that, you also got to take note that revenue is affected by unfavorable currency translation, but operating expenses will have a corresponding positive effect because of that same currency translation as well. Finally, the PATMI is up 5.3%, largely, or rather, EBIT and PATMI are up, and from the EBIT level is up mainly because of lower energy costs. So their energy costs comes from the lower diesel prices and the lower electricity prices. And as you go down the bottom line, PATMI is up 5.3% year on year. Okay, so now I'll focus a bit more on each of their three biggest business segments. The first one being bus. So for as you're aware, last week LTA has already concluded the negotiations and they made their announcement for the remaining bus packages. We also had a sector report last week on Friday. So for effect on SBS Transit, SBS Transit is 75% owned by ComfortDelGro. So the effect for that transition, we expect it to be positive on SBS Transit, and then likewise it will flow to ComfortDelGro as well. But we are saying that not to expect massive special dividends. Okay, so first bullet point here, profitability will be more stable going forward in view of the structure of the contracting model. So under the new contracting model, they will be paid a fixed amount to provide the service, and they are not vulnerable to the fare box risk. So they do not collect, their revenue is not dependent on what they collect from fares, but it's from a fixed contract amount from the government. Not to expect special dividends, why we say that is a few reasons. Firstly, as we've explained in the sector report last week, the government is not buying the buses over from them. So there will not be a large one lump sum payment in cash for the buses. Instead, the government will lease the buses from them. And then now 2Q16, the latest balance sheet for SBS Transit is that it has only 4.7 million of cash, but it has 8 million in short-term bank loans, which needs to be repaid within the next 12 months. And then going forward, in a bit further next year, they have 150 million MTN due in September 2017, and another 100 million bank loan due in 2018. So with that, you can see that they probably will need to start accumulating their cash so that they can pay off these loans. Okay, next, taxi. Absence of hiring queue could be the canary in a coal mine. So as with last quarter during the results briefing, management said that taxi rate is effectively 100%. That's the same again in this quarter. Tax hire-out rate is effectively 100%, except for some of the spares that they have. Last quarter, they said that the queue for taxi hires has dramatically shrunk. This quarter, they said that the queue, there's no more queue already. So based on this, our expectation is that ComfortDelGro will be more judicious in managing their taxi fleet expansion. So by law, taxi companies can only increase their fleet size by 2% per annum if they pass all the standards. So ComfortDelGro and CityCab have been the only companies who have been able to pass the standards so far since this framework has been implemented. So now in view of this absence in queue for hirers, we think that management will not go on an expansion spree in their taxi fleet, and they'll be more cautious about it. And so because of that, we think that profits from their Singapore taxi business will start to plateau already. For rail, based on the results, we think that Downtown Line is still unprofitable. I'll explain in the next bullet point. And the other uncertainty now for their rail segment is the transition of the Northeast Line to the new rail financing framework. Okay, so ridership for Downtown Line actually grew more than 200% year on year. As explained just now in the previous slide, the growth in ridership is due to the opening of Downtown Line Stage 2. Although they had this much higher revenue growth for the rail segment, but the profit for the rail segment actually shrunk 95% quarter on quarter to 0.2 million. So what this suggests is that despite the increase in higher revenue growth, actually operations have become, the OPEX had actually increased tremendously as well, and such that last quarter it was unprofitable, and that's why this quarter it has got to be unprofitable as well. Much of the expenses went to manpower costs for their startup for Downtown Line 3. So in conclusion, we are still having, we had downgraded from buy to accumulate for ComfortDelGro. Target price remains unchanged at 321. Okay, we've come to the second part of today's webinar, which is supposed to take up half the time. Okay, so we published a industrial subsector REITs report last Friday morning. The title is Brace for a Wave of Negative Reversions. Okay, this is the outlook for the sector. I'll run through it quickly and then I'll dive into more details in the subsequent slides. So first thing, both the sector-wide occupancy and rental fell quarter on quarter and year on year. The sector's rental index has fallen to the 2012 levels, implying that we'll be seeing negative reversions going forward. For industrial space, there's three kinds, which is tracked, which is factory, warehouse, and business park. So among the three of them, we think that factory space will be the hardest hit in the second half of 2016 with the onslaught of new supply. We think that 2017 is going to be worse than 2016 for warehouse space. And lastly, business park space should remain relatively unscathed in this same time period of second half 2016 and 2017, and possibly even further than 2017. For industrial subsector, we're having an underweight view of the subsector because of the overwhelming new supply without a commensurate demand. We recommend tactical exposure through the industrial REITs with strong underlying demand drivers and the ability to ride out the oversupply situation. We are wary of REITs with significant portfolio exposure to master lease expiries. And overall, for the S-REIT sector, we have a equal weight view. This is in line with our report from July. Okay, so I'll just go through this slide quickly. This top half shows rental, bottom half shows the occupancy. This is for the aggregate industrial, and this is broken up into the different sub-segments. So I'll just clarify, multi-user factory is a multi-tenanted building. Single-user factory is single-user factory is a master lease building, and multi-user factory is a multi-tenanted building. All you need to, the key information that you need to get out from this slide is all the arrows are red, they're pointing down, it's no good, there's only one green arrow. Okay, this is the key takeaways from the quarter. This is what we have heard from the REIT managers. So this is, we don't quantify much things here. It's just a situational feedback from the REIT managers. So first thing, leasing market remains soft. Even data center segment saw weakness. So across the board, the REITs, there were generally negative reversions. Only two of them had a positive reversions, which was Ascendus, which I think was 4%, positive 4%, and Mapletree Industrial, which was 0.5%. Keppel DC REIT had to give a rent incentive, which was slightly lower than the passing rent, albeit on a forward renewal to a major customer that was expanding its space. So the thing is that you have a major customer and it's doing a forward renewal, so it's not out of the ordinary to give some incentive for such a customer. And in addition, the customer is also expanding space requirement. Second point is tenant retention is paramount. We kept hearing this over and over again from the managers. One of them recounted an instance where it was in late stage of negotiation with a prospective tenant, and that tenant's existing landlord finally undercut them, and they lost that tenant. Third thing, from the tenant's point of view, tenants are opting for shorter leases and they are not willing to commit to forward renewals. So the tenants are actually facing uncertain outlook themselves for their own businesses, and that's why they are reluctant to sign long leases, and they are also reluctant to make commitments on forward renewals. And the landlords are also allowing the shorter leases in order to maintain occupancy in their portfolio. They are also resorting to leasing out partial units on short-term leases. Short-term leases could be in terms of a few months, that kind of short. So our investment actions for the REIT sector, firstly, equal weight view on overall S-REIT sector. This is from our report on the 18th of July, and then we had a report last week on the 11th of August, which is specifically for the industrial REIT subsector. So our view is underweight on the industrial REITs within the S-REIT sector. We have 4 industrial REITs under our coverage, 3 neutral and 1 accumulate. I'll go into a bit of detail into each of them in the following slides. Okay, so first is Cash Logistics Trust. The key thesis for this is cautious over the possible overhang of warehouse space. So as I've said just now, and I'll go and explain why in a later slide, our analysis suggests that the situation for warehouse space in 2017 will be even worse than 2016. And then for cash, 25% of its leases by gross rental income will be expiring in FY18. That will be a year after what we're saying of 2017. These leases in 2018 are substantially from a master lease of CWT Commodity Hub. So if there's a lot of vacant space in 2016 and 2017, these vacant spaces will also cascade over into 2018, and this will put pressure, continue to put pressure on occupancy and rentals in FY18. Keppel DC REIT is a proxy to explosive growth in data requirements. We are currently having a neutral rating on this. We downgraded it sometime after Brexit. The price has appreciated about 12% since then, and the valuations now appear stretched at 1.3 times price to NAV. Keppel DC actually has got one positive catalyst, is the impending acquisition of Keppel DC Singapore 3, which was formerly known as T27. That's from their sponsor, Keppel T&T. The other catalyst also is that last week they have announced the acquisition of another data center in Milan. I'll be giving an update on that sometime later in this week. Okay, moving on. Mapletree Industrial Trust, key thesis for them at the moment is DPU growth from pipeline of build-to-suit and asset enhancement projects. So they actually have two projects going on now, one of each, one BTS and one AEI. We also downgraded it to neutral because of the 11% price appreciation after Brexit, and valuations are also stretched at 1.3 times price to book. Okay, for the BTS project is for Hewlett-Packard. It's expected to contribute about 10% of portfolio, the GRI, and it will be completed in 2 phases. As for Kallang Basin 4 Cluster AEI, it's due to be completed in 1Q 2018. So you can see that they have a visible pipeline of project completions, and the BTS project for Hewlett-Packard is going to contribute about 10% of the portfolio GRI. So that's quite a big project, and that's where their DPU growth will come from. That will start to fully contribute after 2Q 2017. That would be for them FY17. Sorry, that will be FY18 for Mapletree Industrial Trust because their FY ends in March. For Soybuilt Business Space REIT, has stability from master leases and negligible vacancy risk for the rest of this year. This is the only REIT where we have an accumulate rating on. So for Soybuilt REIT, they do not have any master leases expiring within the next 2 years. The next master lease expiry will be for Solaris, which contributes 23% of their portfolio gross rental income. The expiry of this lease will be in August 2018. So that's 2 years away from now. They have one negative catalyst, which is their tenant has defaulted, the one at 72 Loyang Way, which is Technics Offshore. So they are attempting to lease out the property piecemeal, but the risk is that they may not be able to fully lease out the whole property, even if they cut it up to multiple tenants. They do have a positive catalyst, however, is that they've already announced acquisition of Bukit Batok Connection, and that's subjected to unit holder approval at an EGM. Okay, now I'll go into more details of the JTC data that was released recently. Firstly, this chart shows, this slide shows 2 charts. One is the sector aggregate industrial sector occupancy on the left, and on the right is the rental index. So firstly, occupancy you can see has been coming down all the way since first quarter of 2012. For rental index, both quarter on quarter and year on year, you can see it's lower as well. 2Q 2016 it was 96.2 and it's lower. The thing that you need to know is that industrial leases, they're normally signed for 3, sometimes 4, and maybe rarely at 5 years. So the thing that you should focus on is here at 2Q 2013. So you can see that leases signed 3 years later, which was 2Q 2016, are here. And so you can, from here, it implies that there were, on aggregate, there were negative reversions across the sector in aggregate. The next thing that you should look at is 3Q 2013, which is here, and you can imagine what's the reversions going to be like in 3Q 2016 this year. In aggregate, it is going to be negative. Now we move on into each of the individual property types within the industrial sector. So now we're looking at factory, where it's single user and multi-user. So for single user, we don't really look at it much because they are normally for master leases, and these do not happen as because master leases are normally a lot longer, they do not happen so frequently. So we just focus on the multi-user segment of the factory space. Likewise here, if you compare 3 years ago, you should be looking here. This is where the rental index was in 2Q 2013, and 3 years later when they signed their renewals, it's here. So going forward, 3Q 2016, you look 3 years back, you would be looking here at 3Q 2013, and from this you can infer that most likely rentals signed in 3Q 2016 are also going to be on negative reversion terms. Moving on, business park. So you can see business park is the only one that's still looking stable. 3Q13 was here and 3Q16 here. 2Q13 was here and 2Q16 is here. 3Q13 is here. So we think that 3Q 2016, there's still some possibility of positive rental reversions for business park in aggregate. And lastly, warehouse. Warehouse also not looking good. This is where it was 3 years ago, 2Q 2016, and this is where it was signed in the most recent quarter. It's also lower. This is 3Q13, and this is the benchmark to look at for 3Q 2016, where reversions will be. And from here, I think it's quite likely that reversions in 3Q 2016 are going to be negative as well. Okay, so the chart on the left is something that I've shown before. It's just showing the supply pipeline for the remainder of the year. So although it says here 2016, actually is referring to 3Q and 4Q of 2016, how much space is coming out for each of the three types. This is 2017, 2018, 19, 20, and beyond. So you can see not much new business park space coming out, and none planned in 18 and 19. A small piece again coming out in 2020. The interesting chart is the one on the right here. So what this shows is that I've broken it down. For factory, I've split them into multi-user and single user, and as usual, warehouse and business park. What the blue bars are showing is the actual amount of new supply that has come out in the first half of this year, and the orange bar is showing the new supply that is projected to come out in the remainder of the second half of this year. So from here you can see for both multi-user factory and single-user factory, about only 14% of the full year planned supply has come out, and second half they'll see the remaining 86% of it coming out. So for factory space, there's going to be an overwhelming amount of supply coming out compared to the first half of this year, and that's why we have this. That's why we're saying that factory space for 2016, majority of them come out in 2016, and second half is going to be worse than the first half of this year for landlords in the factory space. Warehouse is okay. Most of it came out in the first half and less than half of it remaining in the second half. But if you look here, actually this orange bar shows the amount of space that will be coming out in 2017, and this is what's going to come out in the second half of 2016. What you need to know is that for 2017, the new supply is going to be 20% more than the new supply in 2016. So that's the reason why we're saying that warehouse is going to be even worse in 2017 than 2016 because of the added 20% more supply. Now, if you look at demand side, or a proxy for demand, that is the manufacturing indicators. In summary, the indicators are saying that industrial activity has been in contraction mode and expect weak demand for industrial space. So for the PMI, you can look at it. This goes all the way. We're showing all the way from January 2014, but PMI has been below 50 for the most part of 2015 and for the whole of 2016 until July. This data is until July. And for industrial production, it's also been weak. In June, it fell 0.3% year on year and 2.5% seasonally adjusted month on month. So because of this, it looks like demand is going to be weak, and we think that it's unlikely for industrialists to go on space expansion spree. So now you have a combination of onslaught of supply and almost no incremental demand. Okay, so now we'll go into our views for this. So firstly, we're seeing further downward pressure on sector occupancy to be expected as new supply outstrips historical supply, and this is in combination with weak demand. So for second half of 2016, JTC is estimating about 1.6 million square meters of space, and for 2017 is 2.04 million. So this is actually significantly higher than the average historical supply of 1.7 in the last 3 years. So these 2 years, the 2016-2017 supply is even more than the historical last 3 years. There's a lot more supply coming up, but demand is weak. Second bullet point here is industrial sector rental index is at 2012 levels. Aggregate reversions were negative. So I've shown the charts just now with the rental index on the right half, and that's why we're explaining why we think that reversions will be in negative territory all the way into 2017. We are also saying that factory space is looking dire. It will be the hardest hit in second half of 2016 with the onslaught of supply, and in particular it will be the multi-user factory segment. So the rental index for that is only the rental index is already lower than 4 years ago, that's 2012, and only 16% of the space was completed in the first half of this year, and an overwhelming supply where the remaining 84% is coming out in second half of this year. So if first half was bad, second half is going to be worse. Multi-user factory space woes will be exacerbated by new single-user factory space. So the thing is that for just like the multi-user factory, for the single-user factory, only 16% of the space was completed in the first half, and then there's 84% coming on stream completion in the second half of 2016. The thing you have to know about single-user space is that they are typically pre-committed or built to suit, meaning that new spaces already have a user in mind who will be taking up the space. So that new space for single user will almost definitely be absorbed, and there's no vacancy risk for that. But what happens is that these users actually are already in some existing buildings, and when they shift out to their new premises, they'll create a vacuum at the old place that they are vacating. And at this point in time, it's really difficult to find one tenant to take up one big chunk of space. So the newly vacated space will inevitably have to be chopped up for multi-users, and that's why it will exacerbate the oversupply woes for the multi-user segment. Okay, we have also said that 2017 is going to be worse than 2016. So we've shown that rental index now is really lower than 3 years ago, and this implies that leases that were done or leases that were signed in second quarter of 2016 were already done on negative reversion terms. That's why we're saying that with new supply, there's going to be further downward pressure on rent expected in second half of 2016. And just now I also showed the chart where new supply in 2017 is 20% more than the new supply in 2016. So that's why we're saying that 2017 is even going to be worse than 2016 for warehouse space. We know the PAC will be a business park because of limited new supply. There's only going to be a 0.7% increase in the second half of 2016 over existing supply, and 0.2% increase over existing supply in 2017. No new supply in 2018 and 2019. Minimal increase in 2020, and rental index is still higher. Rental index at second quarter 2016 is higher than second quarter 2013. So there's still the possibility of positive reversions in the second half of 2016. Top-down view for industrial REITs, we are negative on it due to the oversupply of space. Our tactical bottom-up view is to maintain exposure to REITs with strong underlying demand drivers and ability to ride out the oversupply situation, or visible pipeline for inorganic growth. So such REITs, we have named them in our report: Capital DC REIT, Maple Tree Industrial, Soybean REIT. You can refer to page 5 of our sector report. There's a bit more details on how these three REITs meet the requirements that were stated. And then we are wary of REITs with a significant portfolio exposure to master lease expiries. Again, on page 4, we have named AIMS AMP, Cambridge Industrial Trust, and Sabana Sharia compliant REIT. So you can refer to page 5 also to get more details on their exposure to master lease expiries. Okay, so this is just some backward-looking things. Is quarterly. This is just a recap on what happened in the period in the recent quarter results. This shows all the 10 industrial REITs grouped according to when their FY ends, and they're just grouped in alphabetical order. This shows their gross revenue, then going down their income statement will be net property income, distributable income, and finally their DPU. So you can see some green, some red, but you know, as you transition across right to the bottom line of DPU, you start seeing more red arrows than green already. This summarizes the general trend across the industrial REIT sector. Firstly, gross revenue growth. Those that had growth in gross revenue was driven by inorganic growth and completion of their AEI. So those that had acquisitions that drove their inorganically drove their revenue was Ascendus REIT, Cash, and Viva Industrial Trust. The one that had growth through completed AEI was Cambridge Industrial Trust. Then if we go down the income statement, there will be NPI. NPI was generally in line with GRI. There was some negative impact on the NPI level from prior conversions from master leases to multi-tenancies. This was seen for Mapletree Logistics Trust, Cash Logistics Trust, and Sabana Sharia compliant REIT, with Sabana taking a real big hit here. Distributable income broadly in line with NPI, so nothing much to talk about there. DPU was broadly in line also, but some impact in REITs with dilution and those with absence of capital distribution. So those with dilutive effect from a larger unit base were Cash, Soybuild REIT, and Viva Industrial Trust. Absence of capital distribution was Cash and Cambridge. So I'm going to explain what is the meaning of absence of capital distribution. So for these REITs, a year ago or more than a year ago, they did some divestment of a property, and they paid out some of the divestment proceeds in their distributed income, and that boosted their DPU a year ago in the second quarter of 2015. But this year they are not paying that capital distribution, so that's the meaning of absence of capital distribution, and this happened at Cash and Cambridge Industrial Trust. This is a table showing the performance measures across the subsector as of end of June 2016. It shows occupancy, WALE, gearing, weighted average debt maturity, cost of debt, and interest coverage for the subsector. You may look at it in your own time. This table shows the peer relative valuation. This is based on prices on 11 August, that's last week. They are arranged by market cap. This shows their price per share, price to book ratio, and their 12-month trailing yield. So one thing to point out, as I said, Mapletree Industrial and Capital DC, they are already at 1.3 times price to NAV. They are already the they are already receiving a premium valuation across the street already. This is a graphical representation of the previous page. It's also showing the price to NAV and the 12-month trailing yield. The size of the bubbles is their market cap, so you can see the relative market caps and their valuation in this visual representation of the previous chart. Okay, so we have come to the end of the conclusion. We'll pause here for questions. We have a question on Sabana REIT. Yeah, can you refer to the report? It's on page 5.
We have a question from Adrian. He's asking whether we recommend accumulate or hold for DBS at target price. So based on our report, it's accumulate target price 16.9. Thank you.
Okay, actually, we do not see any more questions. So with that, we'll come to the end of today's webinar. Thanks for tuning in. Do tune in again next week for our next webinar. Thank you. Bye.